about today's session because we will be able to have just more of an ad hoc conversation and answer some specific questions that really were thematic of our webinar from Tuesday, but also questions that you as participants on this webinar might have today. So quickly wanted to thank the Seattle Metro Chamber again for putting this on, and Business Health Trust, their insurance platform that serves businesses from 2 to 200 employees, and the event sponsor Comcast Business. A few webinar logistics. If you need help during the webinar, please use the chat box. If you have questions for Eric or I, please use the Q&A box. We will be able to get to hopefully a lot of those today, which will be fantastic. And we also will have a recording available on the website for tomorrow. I believe that Lee will also be posting the slides during this in the chat function as well. Also, just a reminder that none of this presentation is intended to give legal or financial advice, but hopefully to give understanding and context and have a conversation around some of the unknowns right now and give folks the ability to really start to process through some of this as they may have their PPP loan, which is absolutely fantastic. With that, I would like to welcome Eric. And just a very special thank you for taking more time, Eric, to talk with us. I'm so appreciative of Lane Powell, and one, that you guys are out there talking about this, talking about some of the unknowns and helping business owners and operators way through the crazy. You just gave an example of everybody on the freeway together. You know, the posted speed limit is 60 and everybody's going 65. Do you go with the flow of traffic, or you just kind of don't know, right?
And it's even worse. We don't have a posted speed limit.
That's true. Yes, that's what you said. You're in Montana where there is no speed limit.
and we don't know if we're speeding at 65 or not, but we're all kind of on this road together. And there are some people passing us on the left and some people going slower on the right, and trying to figure out what speed should we be doing when without guidance, we're out there. And I know we'll get into this, but I think the key in everything for this is always be reasonable. Be able to, explain your decisions, to a stranger, and it makes sense. And as long as you're being reasonable and, doing what makes sense and not trying to take advantage, then you will be with the group, and you generally should be safe.
Yeah, on the slide, folks can kind of read through kind of that spirit of the PPP that we talked about on Tuesday. As we've talked about, talk to SBA and makers, I think there's also a reality to remind people of that there's not perfect guidance right now. And in absence of perfect guidance, you can't be expected to do it perfectly. Using that sound judgment, making good business decisions, and acting in good faith is likely what the banks, what SBA is going to be looking for through this process. So although there's ambiguity, keeping that reality in check of, we can all just do our best right now, right? So we will go through a few questions, and as questions are coming in as well, we'll be answering those either live or addressing them in the presentation. I do see a question about unemployment claims and what to do with employees who might be making more on unemployment, and we will get to that question specifically through this presentation. It's a really tough one. So just a quick few high-level things. We had a lot of people just wanting clarity on when the loan period starts. The loan period starts when you get your money. So when that check is cut from the bank, or if it's a transfer, when that transfer is made. So I'm hearing most people are getting transfers, but if you have a check, you can use that check date as that. And the other question that I'd love you to weigh in on, Eric, is the PPP a use it or lose it? So you get $1 million, you only spend $800,000. Talk to us about that.
Yeah, so I think the correct answer is, it is use as much as you can, and what you can't get forgiven, then you can't get forgiven. And the SBA provided guidance, kind of created their own 75-25 split that said, no more than 25% of the forgivable amount can be for forgivable costs that are non-payroll costs, mortgage, interest, rent, and utilities. And I understand how they got there. So, leaving that as it is, I mean, whether that's a good thing or not, that's the rule. And so basically what that means is it's another cap. What you do is you figure out your payroll costs during the covered period, during those 8 weeks. You divide that by 75%, and that gives you the most that can be forgiven. And even if you have forgivable costs totaling your loan, if you don't satisfy this 75-25 split, then not all of it will be forgiven. The problem is that, these rules that the SBA gave were rushed. And in one section, section 2.0, they talk about this 25% limit for non-payroll costs. And then in a different section, section 2R, there's kind of this errant sentence. It says that 75% of the PPP loan proceeds shall be used for payroll costs. And that's creating a big concern that people are saying, well, wait a minute, if I have $1 million PPP loan and I use only $745,000 on payroll costs, does that mean I'm going to lose forgiveness? There's a lot of discussion in articles and even in Forbes and, good, well thought out articles discussing this. I can't say it's not a risk because that sentence is there, but ultimately it's that kind of treatment isn't right or fair. It cannot be that somebody spends $745,000 of $1 million loan to protect payroll by paying it out. And then the government's going to come in and say, oh, too bad, you didn't spend $5,000 more. You get no forgiveness. I mean, I think this is where we kind of have to step back and say, did you act reasonably? The SBA has been fantastic early on in providing guidance that was always making it easier for businesses to get these loans and being friendly. And I hope and imagine they will come back. The last thing I'll say is I just can't imagine given how big and widespread this is and how many businesses would be hurt by that 2R provision, that there's just no chance, especially in an election year, that we're going to let that happen to so many businesses.
Yeah. So if somebody spends 100% on payroll, that would be 100% forgivable, likely. So if they spend it all instead of the 75-25.
Yes, but keep in mind that the loan was 2.5 times monthly payroll, and then your 8-week period is just under 2 months. So it's difficult to spend, to spend 2.5 times something on, a period that's less than 2 times it. So yes, you're right. You could spend 100% on payroll and that would work, but you can only do that if you pay people more than what they got for calculating the loan. And that can become, especially difficult given the $100,000 cap. Because,
right. Or another situation could be, that the company had grown from that calculation period, or, they have a lot of overtime right now and people are being paid time and a half, or, so that I could see a couple things, or their insurance rates went up recently. So there could be some legitimate reasons for that.
Oh, absolutely. But what, in the, in the interim final rule, the SBA kind of laid out its expectation that people will spend 75% of the loan on payroll costs. If you spend more than that, that's forgivable, but it just means you are paying more during the 8-week period than you paid during the period you used to calculate the loan amount. Totally possible, but I don't see most businesses having that.
Yeah. Do you think that there's any realistic expectation that because many states are under stay-at-home orders that the 8-week mark will be extended or fluctuate, or do you think that that's pretty cut and dry?
Right now it's cut and dry. It's clearly 8 weeks. I think, the plan is, just think how different the world was 8 weeks ago. I think the idea is these loans will get us through the next 8 weeks. If we are still under the stay-at-home orders, if there's still issues going on, then, Congress will have to address that and figure something out. But I think the hope is that this provides enough liquidity to get us through the next 8 weeks. And during the 8 weeks, and keep in mind, if a business, is spending most of its costs, is using the PPP loan money to do that, even if you're a business that is shut down, or mostly shut down, I should say, if you're a restaurant, you might still be having takeout and carry out orders. You might still be getting money in the door. And now the nice thing is that you don't have to use that money for these expenses. You have the PPP loan to pay those expenses. So you kind of can start building up a little bit of a reserve during the 8 weeks. And so that when we get to the 8 weeks, we'll have to evaluate where everybody is. But right now it is a cut and dry. It ends after 8 weeks. And then there's also language, it can't go after June 30 anyway. So there'd have to be a lot of changes in the law, but we can change the law at any time, obviously.
So I see a question. There's some talk about SBA being pretty hard-nosed about documentation and not allowing the forgivability of PPP that are commingled in current banks. So needing a separate bank account. Is that something that I haven't heard that, but would love your opinion on that.
I've heard a lot of concern about that, and I've heard, seen articles where they're saying, you should put the PPP money in its own separate account and only write checks out of that account and kind of really keep track of it. I think that's unrealistic. I think that, I should first say that makes sense for a smaller business that, doesn't have the ability to kind of keep track of its expenses very well, that, kind of stereotypical, shows up with the accountant each year with a shoebox of receipts. Then yes, a separate account will just make it easier to track. The loan documents I've seen and where, they're going is will be that, they will want to look at, just any canceled check that proves it. If you use something like QuickBooks, that kind of chart you're maintaining to show, the idea would be is, and as we'll talk about at the end, the idea is that we'll need to make it easy for the banks. And so borrowers will have to go to the banks and say, look, this is what I spent on payroll costs, and here's the support for it. It doesn't have to be the same account. But the way I kind of think of it is each of the forgivable costs is normally a deductible cost. You get a deduction for payroll, you get a deduction for mortgage, interest, rent, utilities. Well, you have to, in order to take a deduction for tax purposes, you have to maintain documentation to substantiate that deduction. So I kind of think of this as, well, the same records you've been keeping long before this to substantiate your deduction for these costs is what you need to provide to the bank. The difference is, normally you kind of keep those things just in case you're audited. Now you just have to think of it as, okay, I've been audited, essentially. So let me just marshal those documents, put it in a spreadsheet, and mark these things to make it very easy for the bank to be able to say, okay, they say they spent $750,000 on payroll costs. Here's the proof of the $750,000. But to get back to your question, I don't see any need for a special bank account. And I think it is very common for a lot of people to have gotten a PPP loan. It could very well be from a bank that is not their normal operating account, and to transfer that money into their regular operating account, which is where their payroll is normally swept from. And I don't see that as a problem. They will have documents.
So just a reminder, unused funds roll into a loan that is really favorable terms. So again, not the end of the world to have a 1% interest loan that can be paid back, no prepayment penalty and such. That was a common question as well. Do you have any thoughts on?
Sorry, one thing I just wanted to add on the unused funds. I just want to make sure people realize it also includes unforgiven funds. So right. if you spent the money on a forgivable cost, but you didn't have enough payroll costs to let it be forgiven, you still have to pay that back on amazingly great terms, but you might not have the cash.
Okay, that's a great clarification. And talk to us about, do people need to show or prove financial hardship? SBA put out some clarifying guidance today, right? Yes,
they did. What happened was, as we all saw, there was somewhat of a backlash when we saw that, Ruth's Chris, Shake Shack, Potbelly got PPP loans, and it led to a lot of discussion about this certification. And including, I think Senator Rubio had a tweet talking about how, you can only get this loan if you've had a hardship. I want to be clear about this. The certification a business made was concerned the uncertainty of current economic times. And you can have uncertainty without actually having a hardship. Now, our website at Lane Powell will later today have a discussion of this issue because the SBA did provide guidance. But, our view is that there's always uncertainty. In good economic times, you always have uncertainty. So you can't use that. It's the uncertainty of the current economic times. And I think no matter what your business is, you're uncertain. I'm at a law firm. I'm uncertain if my clients will be able to pay the bills. I mean, I might be busy and have work, but I need people to pay me. If you own rental real property, you're concerned. I mean, there's tremendous concern out there. And what the guidance from the SBA that came out today confirmed that. They talked about how you have to assess your your economic resources and what you have available to you that wouldn't cause a significant detriment to the business. So you could be a business that has a line of credit, but if you draw on that line of credit right now, that's a detriment. It seemed to me that the guidance was really targeting publicly traded companies that have a high market value and have easy access to capital markets like investors rather than debt. So nothing in the statute requires you to prove of financial hardship. Nothing in the guidance requires it either. But the best practices will be to memorialize what is the current uncertainty that your business has. I mean, go through that list of what are you worried about happening? I mean, as I said, if you're a restaurant, you're worried that even when the stay-at-home orders are lifted, people don't want to come to your restaurant anymore because they're concerned. You're worried about the food supply chain. We're seeing in the Midwest, meatpacking places having flare-ups of coronavirus. That could in fact impact your food supply. If you're a landlord, you're worried that your tenants aren't getting money. I mean, and again, all related to the current pandemic. Memorialize that, put in place, think through what are those tough choices you'd have to make if you didn't get the PPP loan, or if you felt you had to give it back because of the certification issue. Make it clear what are these things you're going to do, and have it there, because at the end of the day, the key will be, is it reasonable? Can you go to somebody and say, look, these are the things I'm afraid of, and it passes, it makes sense. It's not, some stretch.
Yeah. I think that question, I've heard a lot of talk about, but to your point, I think everybody has economic impact right now in some regard.
Exactly. And again, it's, obviously, there's, as I said, always uncertainty. I mean, if you live in earthquake country, it's always uncertain whether there'll be an earthquake at any time. That obviously is not uncertainty about the current economic conditions. But I think you're right that everybody, that nobody knows how other people's businesses are doing, and we all rely on each other's businesses.
Right.
And nobody knows if people are going to show up even if you're open, because your customers are scared.
Yeah.
And as I said, I think the key is to document it, to be able to say that we thought about this, we discussed it, and we made the decision that it is reasonable to certify that we are concerned about current economic conditions.
Regarding unused funds, so you don't use some of the funds, or they're not forgiven, it gets rolled into a loan. Are there restrictions, or maybe I'll just say, my understanding is there are not restrictions on what you can use that money for. Is that correct? Correct.
I mean, I think the unrestricted nature of how you can use the money was one of the things that prompted that 75-25 split. Right. Because, if you use it for something other than, if you don't use 75% for payroll costs, if you use most of it for something that's not a forgivable cost, especially payroll, it's going to be a problem. I would also warn against, if you take this PPP money and you use it for something that's not a forgivable cost. I mean, use an extreme example. You borrow this money and you use it to pay dividends, to do stock buybacks or pay out money to your owners. and you don't have other there'll be, if you use it for that, or if you have that happening at the same time, because obviously cash is fungible, that will lead people to question, well, how reasonable was your certification? I mean, how worried about current economic conditions can you be if you're taking cash and using it for things you don't need to spend it on? So I again, it's a matter of being reasonable. I think, you should be focusing on, spending regular expenses and not doing, kind of things that, optional, using the money for optional amounts.
Right. So let's talk a little bit about payroll costs. There's two things in particular I wanted to highlight. One is around the $100,000 wage cap annualized. So in my head, if, I go, 12 months, 100,000 divided by 12 for 2 months. Clarification, it's 52 weeks. So 100,000 over 52, which gets to 15,384 over 8-week period. So for those earning over 100,000, when you're doing your calculation, if someone makes 16,000 over that 8-week period, you would need to adjust your request amount for forgiveness down to the 15,384. And that cash amount includes, wages, tips, commissions paid, and also if people are using vacation. So any actual cash compensation that they're getting versus the things that are above that limit are their health insurance. So they're not getting that cash. The company is paying their health insurance on their behalf. Their 401k match that the company is paying, to benefit them, but it's not cash compensation. Is that an accurate description?
That yes, and when you look at what the SBA guidance, when they did this, they said that the compensation not subject to the $100,000 cap would be non-cash benefits. Right. So it's not that it's all benefits are exempt; it's non-cash benefits. And so if you pay out vacation, parental, family, or medical leave, if you pay it out, or if you pay out severance, that's a cash benefit. That's cash in the employee's pocket. On the other hand, when you put money in a 401k plan, that doesn't put cash in their pocket. It's future cash, but not cash today. Same thing when you pay for health insurance. Although it's not entirely clear, I have interpreted health insurance benefits to include employer contributions to an HSA account.
Okay, so that could be a more gray area.
It's a gray area, but it's not cash in the employee's hands.
So speaking about cash in people's hands, tip. So I wanted to just address that the final interim rule, which I think is a funny description, contradicts itself, talks about that you can make a good faith estimate on tips, but it doesn't talk about that in terms of commissions. I think, again, reasonably, my non-legal, non-financial thought would, if I'm a business owner, I might calculate a reasonableness on that. But one of the gray areas that I just wanted to point out. You're nodding, so I think you're agreeing.
Yes, and I guess the thing I've told clients is, look, you took into account tips, commissions, everything when you got the loan. So paying all your employees at the same rate they were getting in 2019, which, if they work on commission and they can't right now make the sales that generate the commission, then replace the commission. It's still a payroll cost. It's compensation. It's a different type of compensation, but replace. Give them the money that they would have gotten based on the calculations you made to get the loan.
Right. And skipping ahead to one question. So let's talk a little bit about paid versus incurred. This is a big topic. Yes. When I think of the big buckets of topics, it's this, and then, also like, how does this play with unemployment, which we will get to. And, we don't know. I did want to look at one of the examples that we looked at before, because it kind of talks about it. And again, I think it's that reasonableness piece. But one of as we were talking about, if somebody is over that 75% of payroll, like 100%, one of the ways that could be possible is this paid versus accrued world, right? So you pay something, and it's a partial period. So let's, I'll move to the example, and would just love for you to talk a little bit more about that.
Absolutely. So one of the things I'll say that just to begin with is you have this statutory language that talks about payment, about costs incurred and payments made. And so people are saying, well, does that mean you have to have it be both incurred and made in the 8-week period? Or is it you have a cost incurred, done, a payment made, done, kind of, and you know, I'm reminded of an argument of someone once made in statutory interpretation on a statute that had an and in it, had, you know, A, B, C, and D, and was arguing you need to have any of the four, not all of them, and you know, kind of made the line of, if you saw in a clothing catalog that a shirt came in red and blue, you would know it comes in red and it comes in blue. You wouldn't be expecting to see a shirt that's red and that is both red and blue. And so that's how I look at this. I view this as it has to be incurred or it has to be made during the 8-week period. Obviously, we need more guidance on that. But this example gets into it, which is, you know, payroll costs incurred before the 8-week period that are paid during the 8-week period will count. And, you know, and again, this is that key that, you know, everybody, you know, it is very normal to have payroll periods that are, you know, twice a month, every other week, once a month. I mean, people don't have payroll periods that are going to line up perfectly with the 8-week period. And so it's this incurred versus paid is a big issue because, you know, as is shown in this example, you're going to have somebody where they will make a payment on April 30 that will include costs incurred before, that will include things before April 20 when the window started, but was paid. And they will end the window will end before a final paycheck is made. And it seems silly to force everybody to accelerate payroll and cut 2 checks during the same window. So this is again where we get to, let's be reasonable and let's trust that the SBA will be reasonable in its guidance. And I think you made a great point about, you know, how this, you know, the payroll from before April 20 is so important. You know, the SBA has said they believe 75% of the PPP loan will be used for payroll costs. The actual math, when you look at the actual numbers, you get if you keep everything constant, you are actually just below 74%. I mean, you know, what they even said was about 74%, will round to 75. The way you get to 75%, or at least a logical and good way to get to 75% is, in this example, the amounts paid for before April 20, you know, for payroll that was incurred before April 20, but is paid on April 30th, that's that little bit more you need in payroll costs to get you to 75%. And so I think it is very reasonable to say that on payroll costs, you look at what's incurred and you look at what's paid. It's an either test. I'm not as sure for the non-payroll costs. And the reason for that is there's a statutory difference. The statute starts with costs incurred and payments made, and then it says 4, and it lists 4 different items, and it just says payroll costs. But then for each of the other ones, it uses the word payment. And so that is because, you know, that is something where this may be overly lawyerly, where someone can say, well, they didn't say payment on payroll costs, so you get the incurred. But Congress did come in and say payment on utilities. So it, you know, the utility bill you incurred but didn't pay at the end of the 8-week period may not count.
Okay. Yeah. And I just want to, again, highlight, because this is the Paycheck Protection Program, right? Mm-hmm. So I think that if I look at things where there might be more reasonableness, allowance, and leniency, it's going to be around the payroll side. So when we look at this example in particular, on a 15th and a 30th of the month, you know, you are going to have more wages in that, because you had some, you know, 5 days of wages that weren't incurred during the period. So I think that that's one area to be looking at as an employer and incorporating into a calculation of, okay, I can accrue for the things at the end, or, you know, some people might prefer to cut 2 checks in that period just for you know, I know I can submit this very easily in my tracking, right? I think that's a personal or an accountant decision of what works. But I think that this is a pivotal thing as I'm thinking about things for, you know, the folks that I advise on this, is how they're getting to that 75% in some cases, because there might be some, you know, a fewer hours, or, you know, those sorts of things as well.
Absolutely. And I think you are dead on in saying, in all of this, always remember that it's payroll protection. I mean, we call it PPP loan, but I just find it difficult to believe that anyone will be taken to task for a choice that protected payroll.
Yeah, I agree. I mean, the reasonableness of people and business owners, again, so I don't know if it was you or Lewis who on Tuesday used this example, but I've heard it referred to many times, and I think it's a good reminder, is pigs get fat, hogs get slaughtered. So if you're trying to scam the system, it's not right. That's not what this is intended to do. There will be protections put in there. You know, people will be able to see through that. And if just you're doing things to keep your employees working, or if they're not working, to continue to have that paycheck, have those health insurance benefits, doing your best in that, I think that's where we're going to see the benefit. Absolutely. Just to, you know, to kind of add on to that, I mean, just to give a kind of an example of, you know, one idea we've had is, you know, if you need to increase your payroll costs for people who make under 100,000, and you decide, hey, I should accelerate my normal holiday bonus that I give in November or December to accelerate it to, you know, May or June. You know, that is something all employees can use. That is a, you know, pigs getting fat idea. But the other one I think Lewis raised was, on the other hand, if I decide to hire my 8-year-old son and put him on payroll, so I can, you know, increase the amount, well, now my hog will get slaughtered. Right. Yeah. And I mean, kind of because we're talking about this, I apologize for the people watching. I'm going to skip a few ahead. So you're going to see slides flash by, but we will come back to them, because I wanted to talk a little bit about, you know, more around compensation. So, you know, can you hire a new person? So you are in the course of business, someone had left, you wanted to hire that position, you do. You know, is that allowed in this period? My understanding is yes. And I think you had even said, you know, consider paying a signing bonus, as long as you're within that 15,380. I think it's 384. I think that's wrong by $1. You know, within that cash compensation limit. So wanted to just highlight that for people. And then I wanted to talk about unemployment a little bit. We have, first of all, I think that it's amazing that unemployment is able to support right now, but it provides some real challenges for employers when you have an employee who has been making an extra $600 a week that might be more. You know, I think this is where I would encourage employers to, you know, one, have conversations with their employees about, you know, there are limits to the unemployment, and if they actually are offering work, and are not a high-risk person, the state of Washington actually makes that not eligible for unemployment. So everything right now is still subject to ability to work and available to work. So if you have work, so not just bringing them back to pay them on the side, but if you say, hey, I have work for you, they are not eligible for unemployment. And unless they are a high-risk person as defined by the CDC. So that would be people over 65, or underlying medical conditions such as diabetes, heart failure, lung issues. But it is a very specific list. You know, I've also heard people, and, you know, again, this is just kind of the conversations that I have heard, saying, okay, well, we'll do some reductions, and I know that there might be a reduction calculation we need to do, which we'll talk about in a little bit, but, you know, I'll bring people back at 75%, and, you know, they can collect 25% unemployment and that additional $600 benefit. A lot of people might be in a better position doing that, and again, you know, there might be some incremental cost or unforgivable amount by hours reduction, but there's also ways that employers can, you know, also have FTEs the same if other people are working overtime because someone's not working. So I think there's so many factors there, but just wanted to acknowledge that this is a real challenge for employers and talk through some of those ideas that I have heard. But I do think that it's really important for people to understand that state of Washington still has a, people have to acknowledge, like, yes, I have been offered employment back, which could make them ineligible. Another thing to be communicating with employees is, hey, because I'm able to pay you during this period, there very well might be a point in time in 8 weeks that you're back on unemployment for a period or a reduced hour schedule or something. And so by doing this also helps them long term because it extends that time period that they can be at getting benefits and really getting compensated at what they were before or more. So those are kind of some of my thoughts. That's kind of my soapbox of unemployment. It's really hard. My husband is a business owner and he's talking through these issues. And it's a real struggle, but I think just taking that comprehensive picture and figuring out how to navigate it in this time and keeping people as whole as possible. So I wanted to talk a little bit about FTEs right now. So Eric, this is where I'm gonna lean on you a little bit for this FTE calculation. What is an FTE? Is it 30 hours? Is it 40 hours? Is it 80 hours? Because you're a lawyer right now and working 80 hours a week. Talk to us about how, in absence of guidance, how do people go through this calculation? What do they use?
That's funny because I was going to defer to you as the accountant on what this means. I mean, I think, I think you use kind of the general normal FTE. I believe that's usually a 40-hour week. Maybe it's a 37-hour week. Under the Affordable Care Act, it's a 30-hour week. I'm a little nervous about using that for the PPP loan program, and that's because as part of the CARES Act, Congress also had the employee retention credit, which has its own FTE issue, and there the statute specifically refers to the Affordable Care Act, so it gets you to 30. I mean, it's not necessarily wrong. I just don't know. I guess the idea is to be consistent and be reasonable. As I see it, anything between probably 35 to 40 is normal. This is something where we need the SBA to tell us what is the hours for FTE requirement.
Yeah, and I mean, as an accountant and a former auditor, every time I would calculate FTEs, it's 40 hours a week. So for me, for calculating an FTE over 8 weeks, it's 40 hours times 8 weeks is kind of your base. And you take what people worked divided by that total, and that's how you get your FTE. That does account for part-time people or people that worked overtime. Can help boost that because you're looking at total hours. I do think one thing to also highlight here is that the borrower, so the business, gets to help choose which equation they're using there. So are they using numbers from 2019, or are they using January and February, or is it February and March? Eric, I can't remember.
They use one of the periods is either January and February of 2020, or it was June.
I think it was February 15th through June of 2019. So
yes, yep, and then it's January and January 1 through February 29 of 2020.
Right, and I think that's important for people to do because you could do that math right now and see, okay, which one's going to be more favorable, first of all. And I do like that the SBA gave a little bit of flexibility because I know some companies look a whole lot different in January and February, either for the positive or negative, than they did last year. So being able to evaluate that is actually helpful.
It is, but one thing I cannot stress enough is how much the SBA 75-25 split can really come in and almost override this statutory reduction for a reduction in FTEs, because if you have a reduction in FTEs during the 8-week period, regardless of what your denominator is, you use the more favorable lower number, that reduction is going to make it difficult or impossible to get to the 75% number. So you're going to already get a cap on your forgivable costs, because you're going to be able to forgive all of your payroll costs, but with fewer FTEs, you have less payroll costs. And if you have less payroll costs, then you have less non-payroll costs that can be forgiven. I think I was actually working through it last night and was surprised about the idea that, to use kind of a simple example of, you have a business that received $1 million PPP loan. During the 8-week period, it spends $700,000 on payroll costs. Maybe because they have fewer FTEs, whatever the reason, they spent $700,000, which is 70%. When you work through that calculation, divide 700,000 by 75%, you get $933,333. That's the maximum amount of forgiveness. Now, it may very well be that the company spends $300,000 on rent and utilities during the 8-week period. So that means the company spent every penny of the PPP loan on forgivable costs. However, it will only be able to get $933,333 forgiven. And one of the things that's crazy about this means that the company is going to be out $63,333. That's the amount of the loan it has to repay, and that's on top of the $1 million it already spent. And yet, if it had been able to increase payroll costs by just $50,000, it would have had the whole loan forgiven. So you sit there and just say, the company is actually going to be out $1,063,000 when it could have been out $1,050,000. And those kinds, that's kind of a crazy result, but it's something to think about, to say, look, you're going to be out more than the PPP loan anyway at this point, because of your other existing costs. It would have actually been cheaper for the company, in my example, to just somehow pay $50,000 more in payroll costs. So that would have been out, $1,050,000 for the 8-week period, rather than $1,063,000. And it's a weird, it's just a highlight that you kind of need to run these numbers in the spreadsheet to kind of see, maybe it does make sense to just pay people some kind of bonus at the end of the 8 weeks, because what you pay out in that bonus will be less than the unforgiven loan.
Got it. And so with this FTE calculation, let's say somebody has a reduction of FTEs of 10%. Is that 10%, so that reduces both the forgivable payroll portion and the non-payroll portion?
So yes, but the real problem we have right now, and this is a huge issue, is we don't have an ordering rule. I don't know which reduction you take first. So the statute, the CARES Act, very clearly says that 90% ratio, you apply it to the sum of your forgivable costs. So that sum could be more than your PPP loan. I mean, you could easily have forgivable costs that exceed the PPP loan amount, which is why the statute caps forgiveness at the amount of the PPP loan. So it could, so my example of, of the business that got $1 million PPP loan, let's assume it has, 1.1 million of forgivable costs. Well, maybe it only gets 90% of 1.1 million forgiven. Maybe it's 90% of the million, because you do apply to the loan amount, or maybe it's 90% of the 933,000 cap that arises because it only had 700,000 of payroll costs. And right now we don't have an ordering rule. We just don't know which reduction you calculate first, and that can have that can make a huge difference.
So if somebody, for example, is on paid FMLA leave, someone, let's say, has a new child coming into the world, into their house, so that employee is now on paid family leave, is there an adjustment that people can make on their FTE calculation? Or, what would an employer need to think through on that?
Oh, and that's a great question. I've never even, I don't even know. I don't even know if normally once you put them on once they're on family medical leave, if they're removed from your FTEs. But I get it, they're not working, but you're still paying them at some rate. So I don't know if that does impact your FTEs.
Yeah, I mean, that's a hard one. I mean, because likely they're considered at that same FTE for all benefits and those sorts of things, like their job is protected. You know, I think this would be a reasonableness. I could see an argument either way.
I mean, I think it would be fair to just say, well, no, you know, I'm going to treat them as an FTE because I'm still paying them.
Yeah.
I get my concern in the PPP loan scenario for this is you have someone out on medical leave, and you know, many employers just have a policy that when you take that leave, you still get paid, but you get paid at some reduced level. That's going to reduce your payroll costs, which is then going to trigger that whole 75-25 split, even if there is no reduction in FTEs. You know, and so, you know, it's important to maybe now come in and say, okay, our norm, you know, you're going to get 75% under our Family Medical Leave Act, and we're going to make up the other 25% because we kind of have to, because that's how we maximize our forgiveness. And again, you know, on the whole pigs get fat, hogs get slaughtered analogy, first, you're protecting payroll, so it's reasonable. Second, you only can provide that additional benefit for someone who otherwise is making less than $100,000 a year, you know, with family leave. So if you have somebody who's on family medical leave, and even at, say, the 75% reduction is still making more than the $15,364 during the 8 weeks, well, then there is no reason to increase their pay for, you know, with respect to the PPP loan. There might be other reasons, but you're fine. So it again gets to how much backlash is there really going to be against employers who artificially, or who gave out more money to middle class workers making, you know, $40,000, $50,000, $60,000, you know, less than 100,000. I mean, in an election year, are we really going to target those employers?
Right. Also, a question again in terms of compensation. So owners that are on payroll, you know, they would be subject to the same reasonableness, right? Same limits as others. So, you know, my take was, you know, whatever you included in your calculation, which is based on historical, if you're maintaining that level, that would be reasonable to include in the forgiveness calculation. Is that, do you agree with that analysis, or have a different opinion?
No, I agree.
So I wanted to talk a little bit about, let's talk real quick about non-payroll costs. I'm gonna have to do a little bit of switching here again. Oh, great, this went over everything. So we had lots of questions about mortgage interest. Could you talk more about, you know, we have mortgage interest, and then we also have other leases or rents or mortgages on like a copier or, you know, a line of credit. Could you talk around, you know, what that might look like?
Sure, and I'll have to confess that before the CARES Act, I just assumed all mortgages were real property, because really that's the only concept I'd ever heard of, someone taking out a mortgage. But the CARES Act is clear that it's interest paid with respect to a mortgage on personal or real property. So, and, you know, I then checked with, you know, my, you know, kind of lending partners, and, you know, a mortgage is just securing the loan with the property. So, currently I would say that any loan you have that is secured by a specific piece of property is a mortgage. I mean, you should check to make sure on that, but, you know, so what that means is if you have a general line of credit that's secured by all your assets, that's not necessarily a mortgage. But if you buy a piece of equipment, you're a construction company and you buy, you know, some heavy equipment, and that loan is secured by a mortgage on that heavy equipment, that should work. Also, it's, you know, the statute is very broad. It's on rent. It's just rent paid pursuant to a lease entered into by February 15th, 2020. So that means, you know, if you think of all the offices that rent equipment, you know, that's all subject to a lease. So I don't think it's, you know, I think the lease is, you know, is generous. Now, again, you only get 25% of the PPP loan for that. And you only get 25% of the PPP loan for that, assuming you have enough payroll costs. So, this is good. And one of the things we talked about in our earlier webinar on this is there is no restriction on related party payments. So a very typical scenario is you have a business and it rents property from an LLC that is owned by the same people, and there's a lease agreement where the rent is paid. There is no restriction on paying that rent as long as you have that lease agreement. And one of the things that people really should be doing is it's not too uncommon in that situation where it's all the same people, all the same owners, to never have reduced that agreement to writing. You just have several years of making those lease payments. Need to check what are the local law requirements. I actually don't know if Washington law requires leases to be in writing, or if if an oral lease is enforceable. If it's enforceable, then you have a lease even though it's not in writing. So that's something to kind of check in on.
Okay. I wanted to talk about FFCRA leave. So, if we receive PPP money, can we continue to have employees on various forms of FFCRA leave? And how does that interact with PPP? This is all you. My answer is I don't know.
And I've actually, this has come up. So the first thing I want people to be very careful about with FFCRA leave is this is the Department of Labor. As I said, the SBA has been very, very kind in its guidance. The Department of Labor was not. The Department of Labor has the FFCRA has two different types of leave: a more generous program, a more generous credit, where the employee can't work because they're quarantined or because of a stay-at-home order, and then a less generous credit that will cover things more broadly. And the Department of Labor came out and said that it's a very strict but-for test. So if there's a shutdown order so that the employee cannot come to your business or customers cannot come to your business, that doesn't count for the more generous benefit, because the employee's on leave not because they're sick or because they personally have to self-quarantine, but because customers can't come in. And they put it in a footnote, and it's tough. But that said, it is entirely possible that during the 8-week period, you will have employees who you're paying wages to where they qualify for an FFCRA credit. And the answer is go ahead and use that FFCRA credit, but keep in mind that there's a no double dipping rule, that the wages that you use to get a credit cannot be, are not included in payroll costs that are forgivable. And ultimately what's happening is with the credit is, you're paying a wage to someone, you're paying $1,000 to the person. The government is going to reimburse you one way or another. Either you'll get your FFCRA credit of $1,000, so you're made whole, or you'll get your PPP loan forgiven for $1,000. So again, you got the money and then you got it forgiven. I tend to favor a maximizing cash strategy. And the best way to maximize cash is you got $1,000 in the door from the PPP loan. Then you have $1,000 out the door from the paying the wage. We'll now get that $1,000 back in the door from the credit. And then we can later figure out if you can do some other forgivable payment with it, or worst case scenario, you have $1,000 subject to very favorable loan terms. But it's better to be in the black 1,000. So, but the bottom line is, yes, you can still claim credits, but you can't use those wages in payroll costs.
I wanted to just re-highlight, the situation where businesses are shut down, employees do not have hours to be working, essentially you're treating this as paid leave, right? So if someone normally works 40 hours a week, you continue to pay them for 40 hours a week. You use 40 hours for your FTE calculation, and they are not working. But, when I look at the PPP, I also saw it as a relief on the unemployment system. So if you have someone on unemployment and they're now being paid on PPP, it's kind of, yes, it's unpaid leave. They're not working in either scenario, right? And
Yes.
I know a lot of employers and employees for that matter are thinking, well, I'm not working, I can't be paid wages by my employer. But that's not the case. You can look at this as like unpaid leave that you're providing, which also can help people have all of their regular benefits and those sorts of things as well.
Yeah, I think benefits is a big issue. I know there's a lot of concern about, trying to get people to come off unemployment because they're getting good benefits right now on that. But, healthcare is a big thing. And getting them back onto payroll for that is very, very important. But you are absolutely correct. At the end of the day, this is, the PPP loan system does envision employers paying employees who are not providing services. And yes, it's kind of like a different version of unemployment. I mean, at the end of the day, the employee is going to get a check that is funded by the government. It's either going to be a check from the employment department for unemployment benefits, or it's going to be a check from the employer funded by the PPP loan. And it is kind of an alternative. I think it's good and it's beneficial. I think there's kind of getting outside of kind of the law. It's almost a psychic benefit that I think people prefer getting a paycheck from their employer to getting an unemployment check. Even if in both situations they're not working, it's a lot easier to say, I am working for my employer. I'm being given this essentially leave because I can't actually come in and do anything, but I'm still employed. And I think the PPP loan system is meant to provide that benefit.
Yeah. So we have just a few minutes left. Eric, this is so helpful to just have a conversation around this. We will stick around and try and answer a couple more questions if you have a few more minutes, Eric. Great. So, just clarifying employer contributions, so a match to a 401k or discretionary contributions, part of benefits costs?
I think so, yes. I mean, they did definitely, they talked about retirement contributions or retirement contributions to a defined contribution or defined benefit plan. So, go check to make sure that your contribution complies with ERISA and, all those requirements. But, I think most people use 401k contributions as part of the payroll costs for calculating the loan. And so it is also part of the payroll costs for getting the loan forgiven.
Yeah, great. And then also kind of going through a little bit of math. So there was a question on the forgiveness. So if an employer has their payroll costs that are 92% plus 6% for healthcare, which actually are part of that payroll costs. So you have like your wages, your cash compensation, and then you have benefits that both are within kind of that 75% requirement. So they meet that. And then they pay some for rent. All of those costs are greater than the loan amount. They've met the 75%, assuming they don't have other reductions in there like FTEs. Is it a safe assumption that 100% is forgivable?
Yes. I mean, the thing that I wonder about is, again, rather than use percentages, I think it's easier to use numbers. They got $1 million PPP loan, and then based on this, it's the idea that they're going to spend over $900,000, 980,000 of that on payroll costs and 20,000 on rent. I mean, that's the 98. I guess my question is, that $1 million loan was on the note. You get the $1 million because you had your average monthly payroll costs were 400,000. It's 2.5 times that number. And so I'm just curious how, if someone normally would have spent $800,000 in 2 months, how it is they're on payroll costs, how it is they're spending $980,000 in 8 weeks. So that's, I mean, it can be done with raises and bonuses and all of that, but
I think hazard pay, overtime, the paid versus incurred, part of it depends on when your loan period is, right? And where those span your payroll periods too. I think that could boost it.
But I mean, yeah, absolutely. I mean, you know, so I'm not saying it's impossible, but
or
it's,
they hired some additional folks. It looks like
right.
the gentleman whose question it was just said that. So.
Then yes, no, that kind of situation is, you have protected payroll, you've expanded payroll, that, you know, you're doing everything right. And so yes, if you spend, you know, 92% of your PPP loan on cash payroll, 6% on the healthcare costs you have for your employees, and 2% on rent, then you will get the entire PPP loan forgiven. I mean, now the question becomes documentation, substantiating it, and making sure the bank can easily see that you had those expenses.
Yeah. So going back to compensation a little bit, you mentioned paying a bonus. There's been talk of, does it need to be amortized over the 12 months, or can it be in the period? You know, I think I heard you say earlier, again, it depends on, you know, if you're within that cash compensation limit and the reasonableness of that bonus, right? Retention bonuses, taking care of that, of middle-class workers, those sorts of things, there might be more appetite to say, oh, yep, that was very reasonable, or hazard pay, those sorts of things, to be able to use 100% for the 8-week calculation, or do you think that it very well would be needing to be amortized?
You know, we have no guidance. I think trying to amortize it would be just add way too much complexity for the banks. I mean, so if you think
it would
about
be hard for employers too.
I mean, and you know, but if you think about it, where you have someone who makes, you know, $6,000, who's making $6,000 during the 8-week period, and then you just decide, okay, I'm going to accelerate my holiday. You know, normally that person would have received a $5,000 holiday bonus, and you just say, I'm going to accelerate that. I'm going to pay that in May. So now that person gets $11,000 during the 8-week period. You know, it'll be very easy to show a paycheck for $11,000. That'll be simple. You'll have bank statements for it. Trying to now tease out, okay, what part of that 11,000 was based on their regular comp? What part was for a bonus that was accelerated? And now let's take the 5,000 and, you know, divide it by 8, you know, multiply by, you know, or, you know, sorry, let's take that 5,000 and spread it out over a longer period of time, so you only get a portion of it. I mean, that is complicated. And I just, I don't see the SBA coming in and doing it. You know, what gives me comfort is, you know, if that were a technique you could use for someone who made $200,000 a year, and you could suddenly pay them you know, give them a $50,000 bonus and boost your payroll costs, I'd be worried about the abuse and the concern. But again, the only people who benefit from this are people who would make under 100,000, and the farther under the 100,000, the more they can get in the bonus. So I just don't see you know, I don't see a concern about abuse that would create a need to make all these complicated adjustments.
Right. Well, I really appreciate your time. And we will sign off right now. The slides, you know, we didn't get to everything, but we did get to most of the questions, and there's just a few left that we will answer in the chat box. But these slides will be available. They were also put in the chat function, so you can download those and go through some of these questions and answers, and listen in to re-listen once the recording is uploaded to the Seattle Chamber page. One other plug is just go to the Lane Powell article and look at that calculator. It's very helpful. If you do have questions on how to fill that out and those sorts of things, please feel free to reach out to the Chamber, and we will do our best to walk you through things or point you in the right direction. Thank you, everyone. Hopefully this was helpful to start to talk through some of these things, but just encourage everybody to keep being reasonable and take good care of your employees in this time to the best of your abilities. Thanks.
Thank you.